Hello, everybody, and welcome to another episode of our Southern California housing market update. This is for April 12th, 2022. My name is Stephen Meade. I'm the managing broker here at Domicile real estate for people who love houses and who also love having information about the market. So before we begin, something that I wanted to talk about briefly with you was just to give you a little bit of maybe some perspective on the data that we're going to share. Just because we say something in particular does not mean that that applies to every single house in every single market at every single price range. And I want to emphasize that because when we go through a period where some of these market stats are starting to change, you will notice that different price ranges, different areas even may be affected differently. It's not a uniform result. 6 months ago, it didn't really matter what price range, what area, the market felt fairly similar all over. It was a very homogenous market. And I think we're entering an era where that is not going to be true. So specialty homes, homes that look great, homes that are difficult to replace that come along once in a while, those may have a different market presence on them than some of the more mainstream homes. So a good example of this, right, is architectural homes. Architectural properties will remain stronger than the market as a whole. There are fewer of them. The buyers tend to be a little bit more well-heeled. All of these factors sort of combine to create a stronger market for homes like those than the average home, especially when they are well presented or when they are very affordable. So either of those two conditions will do that. So just bear that in mind as we kind of talk about this. What we're seeing this week is something interesting. I think that things will get a little bit better overall for buyers in this market, but I don't know exactly how soon. It is coming, but I don't know if it's quite here yet. So let's open this up. Let me take you through it here real quick. All right, let's start off and look at our active listings on the market. So again, our blue line is under 1 million and our red line is 1 to 2 million. You can see that we are about where we were last year. We've accelerated into that. We keep going up. And our blue line here is not quite there. So overall, we do have fewer homes on the market than we did last year at this point in time. If you add these two graphs together, we just don't have quite the same inventory under 2 million, but it is getting better. It has been getting steadily better. If you look, this is the biggest kind of increase we've had since the beginning of the year. This is the fastest rate of increase really that we've had in this under 1 million category. So take a note of that because these price ranges are reacting a little bit differently right now. Now, if we look at our new listings, we had a little bit of a dip, but it's kind of rebounded. That's good news. We have more listings in the 1 to 2 million range than we had last year. I've mentioned this a couple of times. I think part of that is there are just more homes in the 1 to 2 million category than there were last year in general, meaning more of our housing stock is over $1 million. But still, if you added these two graphs up, they are still less than we were at last year, but maybe not as much less as they were previously. I definitely see signs that both of these are getting better. That is a good sign. We see that anecdotally in what we're seeing out there, but also in the numbers as shown on the graph. Now, this is actually the really good news. And if you're a seller, maybe it doesn't seem like good news, but I think even for you, it's good news. This is our new escrows in the last 14 days. Again, we're a little bit better than last year on 1 to 2 million. We're quite a bit worse under 1 million. These numbers have both kind of slid a little bit. And one of the things that a lot of us have been talking about, in this field, anybody in real estate economics has been talking about, is this idea, this kind of uneasiness at the market, not maybe responding as much as we thought it should, given the rate increases. You saw this in the Federal Reserve article. One of the things they were talking about was this idea that the market wasn't reacting the way they thought it should, and that was kind of a precarious position. So when I see these new escrows go down, to me, that's good news. That is a market reaction we're seeing as these higher interest rates come into play and are starting to affect buyer decisions. What I find fascinating, though, and when we go back in here, is that it is not affecting price ranges the same. And what I mean by that is we're really seeing a disproportionate reaction to that under 1 million price range. I think these buyers are a lot more sensitive to those interest rate increases. We're not seeing as nearly as much of a downward slope maybe as we would have seen in this 1 to 2 million. Now, where this really comes to play, that relationship with supply and demand, is in our absorption rate. And if you look, I mean, we're actually seeing numbers that really, we haven't seen a number this low in our 1 to 2 million price range since maybe July of last year. We got this little blip here towards the end of the year, but around, I think that was right around our Thanksgiving holiday or near there. Oh no, that was the beginning of the year. So, but look at where we are. I mean, the last time we kind of saw these sorts of numbers were back here, and we've got a pretty big downward slope here for a few weeks now on our under 1 million. And I think what we're starting to see is something we've talked about a couple times before, and that is a stratification of the market. There is a much bigger difference between the competitiveness on the top 25% of listings and the bottom 25% of listings in terms of, desirability. I've made the joke, you could put a porta potty on somebody's driveway, slap a for sale sign on it at 9 a.m. and have multiple offers by noon. I don't think that's true anymore. I think these buyers, what's happening is the demand is concentrating on the more desirable listings, and the less desirable listings are kind of falling by the wayside. I think part of that is, sellers having maybe a little bit of a mismatch, right? They think they can charge anything for anything. And that's simply not true anymore. So if you look on here, I think if this trend continues, I mean, really, this is going to be one of those situations where it really is going to be the haves and the have-nots in the marketplace if you're a seller. If you've got a desirable home, you're going to feel like things are just as busy as ever. But if you have a home that is lower on that desirability hierarchy, you're going to find a much slower market as a seller. Now, if you're a buyer, what's the flip side of this? Well, the buy side of this is, hey, there are actually some opportunities for you out there, buyers. You're not going to overpay for everything. If you want that turnkey beautiful house, yes, it will still be very competitive, but there might be some properties that kind of fall through the cracks a little bit more. If you look at our closed prices, what do we see? Since pretty much the beginning of the year back here, we see this upward trajectory. But remember, these prices are 4 to 6 weeks old. I think we are going to see a little bit of some easing in this. And I think that's really is going to be a function. And by easing, I mean not going up as fast. And I think that is a function of those rising interest rates, especially towards this 25th percentile entry level of the market and our middle of the market. Now, if you look at our other measurement, which is 14 days still active after 14 days on market, these numbers are high, but they're not outrageous, right? Like, remember, higher in this stat means less competitive. This is kind of some of those mixed signals that we were talking about in the market. We're seeing some good trends, and I think if you're a buyer, there's some good things for you coming in terms of market competitiveness, but they're not quite there yet, and they don't extend to all types of properties, price ranges, and desirability levels. Now, if you look at this one, this again is really telling a tale of two different markets and how different that under $1 million entry level market is versus the 1 to 2. So if you look here in our under, our under 1 million market, this list close ratio shot up, and then it's really been flat, right, since about March 1st. But if you look over here in this 1 to 2 million, we're still trending around that 108%. Even if you drew an average through, we're still at 107% of list price. These are buyers that are much less affected by interest rates. In fact, a lot of these buyers are going to have big down payments. They are going to care less about this. And I think that's sort of reflected in sort of this desirability level of the homes that are actually closing, which is what this measures. We've also got our days on market statistic. Just when you thought they couldn't go any lower, they have managed to go lower, firmly under 20 days. And this is for the homes, though. I want to make a distinction about this. If you look at here, let's read what this chart says. Days on market for new contracts. So this isn't the days on market of every property on the market. This is the days on market for the properties that are going into escrow and selling. And that is an important distinction. So what does this tell us? These desirable properties are just as desirable as ever. It's the other end of the market, those lower desirable properties, where we're seeing some softness. Now, this is one of my personal favorites. And I think we introduced this before. We finally have our CPI data for the month of March, which is reflected here in the red line. So what we did is we started both of these off together. And this is, the blue line is the payment on a median priced home at the prevailing interest rates for that period of time. And so these started off together, right, to look at how our housing payments tracking for inflation. And what's kind of fascinating here is if you look all the way through 2021, pretty much this really is tracked together. It is when we got into this new year that we started to see this divergence. And the reality is it's not so much house prices that are driving this divergence, it is interest rates. And here we are up here past 140% of our June of 2000, it should be June of 2018 prices. We're past that, but we are seeing that inflation is starting to move up pretty quickly. So I would expect there to be a premium on housing. We are in a housing shortage in our LA and Orange County market areas. There simply aren't enough houses for the number of people who want houses. So I would expect to see this trend line rise over time, meaning housing rises faster than inflation. But this definitely shows kind of a divergence. We are catching up a little bit, but really these rate increases need to stop so that we can have a little bit of a chance for inflation to sort of catch up with where payments have gone. So I do think we are going to start to see that to some degree. I do think we're going to see that interest rates don't keep going up forever. I know the Fed is trying desperately to get inflation under control. So hopefully they can get a grasp on that. I actually think some economic slowing could help us out a little bit. And that might give us a little bit of easing for this. So, watch this space, right? We want to see this curve flatten out a little bit, because the more this diverges is the more that's why people are talking about, is there a housing correction due? Now, the reality is almost all of this this divergence is a result of interest rates, not quite so much a result just of prices increasing. We had a busy price year all of last year as well, and we didn't quite see these sort of big increases like this. Maybe we'll make a chart that shows if interest rates had stayed the same, from the middle of last year on, what would this look like? So definitely watch the space. This is why we're tracking this. The graph I think we need to add for next week is showing median rent on entry-level single-family homes as well, and track that and index that to see how it compares as well. Finally, we have our prevailing mortgage rates. And really, this is the chart, like I said, that is causing a lot of consternation in the industry. I mean, if you look as recently as the end of the year, we were in the low threes, and now we are firmly in the high fours. I mean, that really is a rather dramatic change in interest rates over a very short period of time. So what I'm hoping is that we're going to see this level off and really give the market a little bit of a chance to catch up and adjust. Well, everyone, that is all we have for you this week. Thank you, as always, for watching. Questions and comments, we'd love them. If you or someone you know is looking to buy or sell real estate in LA Orange counties, we would love to lend you our expertise and help you do that and be your representative in this kind of crazy market that we are in. Don't hesitate to reach out to us if that's the case. We'd love to chat with you. Don't forget to like, subscribe, and hit that notification bell, and we will see you again real soon.